investing is not supposed to be exciting. It should be
Yeah.
more akin to watching grass grow or watching paint dry.
Yeah.
And, and I think there's something there at the end if you want excitement, head to Vegas or something like that,
Yeah, I
uh,
mean, I agree with that. It's like for so much of the running career, and then the investing too is on a day-to-day basis. I don't want to say it's boring, but it becomes kind of routine. You know what you're doing. You kind of get used to it.
yep. Yep.
I enjoyed the process on a daily basis. But at the same time, if somebody kind of looks in and doesn't know what they're looking at, they can say, "Man, like that looks like a lot of the same stuff," and you're like, "Yeah, it's well, kind of what we say is it's blocking and tackling."
Branden Ducharme is an investment advisor representative of and offers investment advisory services through SCF Investment Advisors Incorporated, an SEC-registered investment advisor, 10150 Meanly Drive, first floor, San Diego, California, 92131, 800-955-2517, www.scfsecurities.com. SCF Investment Advisors Incorporated and Ducharme Wealth Management are separate entities. The information in this podcast is current at the time of recording. It is based upon sources and data believed to be accurate and reliable. The information, opinions, and forward-looking statements expressed herein are subject to change without notice. Moreover, all comments and opinions voiced herein are for informational and entertainment purposes only and are not intended to provide specific advice or recommendations and should not be interpreted as such. Further, the opinions expressed are Branden Ducharme's and his guests and do not reflect the views and opinions of SCF Investment Advisors or any of its affiliates. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what is appropriate for you, consult your financial professional. This information is not intended to be a substitute for specific individualized tax or legal advice. Ducharme Wealth Management and SCF Investment Advisors do not provide legal or tax advice. These services are provided by separate entities. The guest speakers featured in this podcast are not affiliated with SCF Investment Advisors, nor are they affiliated with Ducharme Wealth Management unless otherwise indicated.
You're kind of the macro guy, director of research over there.
Yeah.
What are you seeing in the macro data? There's a lot of craziness and uncertainty in the markets, but there's also a ton of fundamental support, positive tailwinds for markets. I mean, just what's your personal take or opinion on sort of the current environment?
I'm probably more bullish than bearish on the current environment. I think the data continues to be strong. That 2 years ago, last year, people were calling for a recession, and those calls just getting pushed out and out and out and further out. And I think the data has just shown that the economy is continuing to plug along. GDP numbers are strong. That productivity number that came out today was solid. We get the employment report tomorrow. That's, what is it, Friday, March 8th. So we're almost a quarter of the way through the year, which is, hard to believe. But forecasts are for solid growth. Inflation, I think that's kind of a little bit of an area, or not a little bit, that's a big part of the dynamic that's driving what people are kind of thinking, I feel like. And looking at, the kind of comparisons, just the way the math works on those inflation numbers is the comparisons get a little bit harder going forward. So you might see that kind of deceleration slow and kind of bottom out. I think a big thing for me is I think people forget that in the 90s, when the economy was running really well, that we did just fine with 3 to 4% inflation and similar interest rates. I think people have kind of gotten lulled into I don't want to say complacency, but they just kind of have this recency bias where the recent thing prior to COVID and the shutdown was 0% rates, which really spurred some kind of irresponsible growth in a way. And there was a reckoning, I think, really in 2022 when the Fed raised rates, and we saw that across fixed income and equity markets. And now there's an adjustment. We're like, well, the rates are still at 5+%, but the economy's growing fine. Earnings forecasts are coming in better. Corporate profits are okay. Margins are holding up. The employment market hasn't cracked. Inflation's coming down, and I think 2%, frankly, is pretty optimistic. But it's things are moderating, and I think we're seeing that the market can move and operate just fine in that environment. It's the the change that's really painful for the market at times, especially in kind of a negative way where you're kind of resetting off of easier comps. But once you kind of get things in line and the market kind of knows what it's dealing with, which right now is higher rates and kind of moderate inflation, companies can adjust and they're able to operate in that environment. And I think for better or for worse, the ones that kind of, shouldn't maybe have existed or shouldn't have seen the growth that they did with 0% rates, there's a bit of a reckoning. But as long as that's, not the whole economy, which it isn't, I think we're plugging ahead. And, I'm as a result, I'm a little more bullish than bearish on things here.
Yeah. What with interest rates? So the Fed target as of right now is 5.25 to 5.5% on the Fed rate, and inflation's come down to, let's call it 3%. So people are, one of the things I've started hearing about is the real effective rate being now 2 to 2.5% roughly, right? And so people are saying the Fed's going to have to lower rates just kind of because of that, right? Like the real interest rate or the real yield is too high over the inflationary number. But one of the things that I've been trying to kind of wrap my head around a little bit is the employment numbers are so strong, the GDP numbers are coming in good, and so if the Fed lowers the rate to something closer to the current rate of inflation, is that going to stoke the economy so much that then it reheats it in inflation? What's your thought?
I mean, I personally I think they should keep it higher for longer. I think that big reset in 2022 is behind us. 2023, I think, clearly showed that companies can adjust and operate. The housing market is a bit of a concern given the higher mortgage rates, but again, that's off of a recency bias of 3% rates. 5, 6. I think it'd be nice if it came in a little bit, but you saw that anchoring already change. Where rates went to 8 and everybody stepped away, and then as soon as rates got like a 7 handle and a 6 handle on them, people started stepping back in because they were anchored up at 8. So a lot of that is kind of behavioral bias that occurs. And, aside from that, I think the Fed could stand to keep rates higher. I think those inflation numbers aren't going to keep coming down in the manner that they did, just the way the math works, as I said earlier. And so I could very easily, lobby for the Fed just to kind of keep it where it is. And it also gives them more room to cut when stuff starts to deteriorate, because at some point it will. That's just the way the economic cycle works. Things will slow down. Germany's in a recession. China's in a recession. Other areas in the world are having trouble, and the U.S. at some point will start to again. The question is, when is that? And I don't foresee it really being, at least not the first half of this year. And so, at least for me, I feel like the government could keep things, or the Fed could keep things where they are, and the economy will kind of continue to chug along. And if, you start to see some cracks in that employment data, maybe they cut a little bit. But again, I think that a lot of this is still normalization coming off of, the COVID shock. And I think that's there, what was that term that was thrown on, the long and variable lags on different areas of the economy. And I think the big thing on that is, like, you didn't know how long and how variable that lag is. And some of these things have clearly taken way longer to play out than people thought. And I think, it's that sort of thing where there's no real reason for the Fed to start cutting right now. So I don't know why they would, especially if the employment numbers continue to move ahead, kind of chugging along. And that inflation number, I think, will start to kind of flatten out. It might grind a little bit lower, but I don't see a ton of movement, below 2.5%, just given the way the math works and the way kind of that things are going right now.
Yeah, I'm trying to think who the first place I heard it was, but the idea that high interest rates, because there's so much cash out in the economy, high interest rates are actually a positive tailwind, right? Because
bringing cash in.
Yeah, you can just have, like no one has anything on the sideline, so to speak, right? You just go put it in something that's yielding, 4 or 5% relatively, obviously there's always risk in anything, but
you can get a CD for 5%.
Exactly. I mean, that's pretty much as close to risk free as you could be. And, you can get 5%. They'll pay oftentimes they'll pay they'll pay the interest monthly to you even. And, now you have, cash to just go spend in the economy if you're that person that has, all that cash, which to the younger generation, they might think like that is so unreasonable. But I think people that are a little bit older, like that's not uncommon to actually have a sizable amount of cash on the sides, or now in cash equivalent or cash-like instruments that are just yielding, good income for them, and providing some financial flexibility to go and continue to participate in the economy as a consumer. As far as the longer for higher, have you ever heard of Joseph Wang? Have you ever followed him at all?
No, I've not.
He's got, so he wrote a book, Central Banking 101. He's an interesting guy. He used to work the trading desk at the Fed. Okay. And he presented at a conference I was at back in fall of 2022. And he started his presentation and said, people that are saying it's higher for longer are wrong. It's higher forever. Yeah. And then he had a really good presentation with some really compelling evidence about why, he felt things had fundamentally changed in the economy, the relationship with China and the labor that they were providing as a disinflationary effect, and everything really has changed. And so we're in a new secular regime or cycle that interest rates would just have to stay higher. So an interesting thing to look at a little bit more. What's your take on, do you have any opinion about the commercial real estate space? One of the interesting things is you're out in San Francisco, right? You're in the Bay Area, and that's that always seems to be the crux everyone's always talking about, right? Is the office space, in the Bay Area. Yeah. And
let's see what stores are closing and leaving.
What's your take on that and the potential ripple effects that could have, coming back through the economy? And then, how would you sort of navigate the waters as somebody trying to manage risk?
Yeah, I think, we've been just, our active sector strategy picks sectors we like and stays out of the ones we don't. And we've been out of real estate for quite a while now. I think we don't see a big compelling reason to go back into it. Kind of from an anecdotal standpoint, funny enough, we're looking at moving offices here ourselves this year. So we're actively in the commercial real estate search space. And there's stuff out there, certainly. I think, here there's a lot of space on the market. But it's hard to say. I mean, frankly, I'm not super familiar with the space. I haven't studied it a whole lot. But you look at kind of the anecdotal stories and these tech companies that, when the shutdown occurred and everybody was allowed to work remotely, they said, go ahead. And everybody fled to, kind of other
St. George,
cities.
Utah is where I think a lot of them ended up.
The joke here was it was like the 4 Bs, which was like Bend, Boulder, Boise, and Bozeman, were the 4 Bs where everybody fled to out of the Bay Area.
That's funny.
And all the real estate, commercial real estate opened up, and now the companies were like, oh, just kidding. Like, we want you back in the office. And so I think that transition is playing out very, very slowly. I think, it's now you're starting to hear stuff where now guys are saying now it's time to buy, or now it's time to get in. And kind of the turning point, you look at, all right, well, it's not going to get more empty than it is now. And frankly, we're right here in the financial district, and it's slower than it was, but you walk around, there's people out walking around for lunch. It's not a ghost town. We're a couple, half a mile away from the kind of Union Square shopping area. And that's been hit a little bit harder, but I feel like a lot of that is kind of the headlines that make things out a little bit worse than they are. And that tends to scare people away. So I think that tourism has been negatively affected, and that's why a lot of those stores are closing. But also, you look at we look at, what is it, retail sales, the e-commerce sales, those are just grinding higher as a percent of total retail sales. So that's kind of a secular trend that was in place to start with, where people are buying online and less so in brick and mortar. And that's not something that's new. That's been around for 20, 30 years since the advent of the internet. So I think, there's certain secular things at play that kind of don't get discussed as much as the kind of, cyclical things that are a little bit more relevant and topical and kind of make for splashier headlines. Yeah.
Well, yeah. I mean, headlines are always all about what sells, not about what's in the best interest of the reader, the consumer. And certainly I would feel comfortable saying that most people writing headlines typically are not saying, man, is this going to put somebody in the right headspace as an investor to make a good decision?
Like that's how it goes.
Yeah. So that's interesting. And, I think I always think back to the idea that somebody as an investor, they have to, investing is so often a long-term game, right? You have to stay invested. You have to stay involved. But the extent or level to which you do that might vary across times, especially as a risk manager. And there's so many headlines out there about, commercial real estate's going to bring down the whole market. And everyone wants to talk about it. And there's validity to it to a certain point, right? I think there's, that's why I was interested in your opinion as a fundamental guy, where you guys are doing a lot of the fundamental valuations. I always think real estate's a very fundamental space. A little bit more difficult from a technical standpoint if you're a technical trader, because of the absolute just uniqueness and fundamental nature. And that's my opinion. But being able to wrap your head around the whole situation as an investor and say, well, if I employ other ideas or strategies and have a well-balanced plan to my entire portfolio, then everything's going to be likely okay, right?
Yeah.
Some things are going to go down in value and other things are going to go up in value, hopefully.
Yeah.
No, neither of us are in the business of ever guaranteeing anything, but through prudent risk management, we can hopefully help people stay a little bit more involved a little longer, which increases statistical odds of having a better experience, I think is a safe way to put it.
Absolutely. I think one of our kind of mantras here is it's time in the market, not timing the market. We talk with, individual investors, advisors, a lot about our strategies. And question we often get is, are you kind of tactical in that you can go to cash when you see things kind of going pear-shaped, getting bad? And the answer to that is basically no. We think our investors, use us because they want to be invested in the market. And if we are expressing a more defensive view because we don't like the way things are going, we will do that through our investments and not just by going to cash. Cash is hard. You gotta get out, and then you gotta know when to get back in. And it's really, really easy to miss tops and bottoms. And I think, for us, it's not worth it. You have those stats, whereas, if you miss like the 2 or 3 best trading days of the year, your return is cut in half. And that sort of thing is like, do you really want to try to time that? I don't think so. Sorry, go ahead.
I was just going to say, I think there's another side of that argument always, though, that people so often forget to talk about. And that's that if you miss also like the worst 3 days. So, not the.
But again,
right.
You're picking the 3 days.
Yeah, you're picking the 3 days. And you get a cherry pick. But I guess the thing that highlights is, they always say if you miss the best 3 days, your return gets cut in half. But it's like if you miss the best, or if you sometimes on those things, and this is a total, I don't have the exact number here. But it's significantly higher than, like doubling the return. it's a way better, right? So because the downside volatility is so much more significant than the upside volatility.
I think the
likely,
corollary to that is the best days come right on the heels of the worst.
Right. And you're right. And then then there's ones that say, well, what if you miss both the best and the worst, right?
Yeah.
What does that look like? And it still looks pretty good. And so I think there is a place in some portfolios, or in a lot of portfolios, there is a place for the risk management style of tactical management, where people are moving in and out of the market, just like there's a place to utilize leverage and not utilize leverage. And, everything goes back to position sizing. But I think that there's also to a certain degree, you're foolish if you take all of your eggs and, put them in one basket. Just like diversification, in my opinion, is a principle that should be applied beyond just asset allocation as a security, if you will, right? So like we would both probably agree it would be really unwise to pick one single name and put all of your money there and let it ride on one single company. I think any seasoned investor would agree. Like, even you could be the most sure investor. Warren Buffett didn't even do that, right?
Well, he's a big story last year.
Yeah, he's classically kind of against diversification, right? He talks about diversification, only gives you more comfort if you didn't know what you were invested in, right?
Yeah.
And he didn't have his money in a single name. I think you're kind of silly if you have all of your whole plan or strategy is all behind one singular idea too, right? So if you're all tactical, I think you're kind of missing the mark. I think if you're, if somebody's all, fundamental only, deep value investor, I think they're potentially missing the mark. It might turn out really well for them and they might be great at it, but your average guy or your average investor, probably should look at a wide range of different ideas and then combine not just asset classes, but different ideas and approaches to build something together that's going to, manage the volatility, try to manage the standard deviation while still capturing the beta of the market.
Yeah, I fully agree with that. I think, when we're building portfolios for advisors and for our investors, we're not 100% of the portfolio, not even close. When we're working with advisors for their clients for a well-balanced, diversified portfolio, you're looking at some of our strategies, and there's a couple other strategies, or strategists that we pair well with.
Yeah.
And oftentimes, exactly to your point, they're very different from a style standpoint. So we're a strategic, you pair us with a tactical and then a fixed income, and you have a good diversified portfolio with names and styles and asset classes, and you kind of get all of it in there. I think, I fully agree with you on that, kind of going all in on whether it be a style or an asset class or a name, over the long term, it is not the way to go. It's, it kind of, you expose yourself to periods of time where the shortcomings of any given strategy will be very, will be laid bare.
Yeah.
And that's why you have other strategies in there, because ideally they work when, as you said earlier, others aren't.
Yeah. One of the questions I'm sort of been dying to ask you, and this is going to put you totally on the spot here, is I've heard that you have an extensive running background. You care to?
I did some competitive running in my past.
Okay. Any good advice? Just general advice. In a parallel that you could draw between running and investing.
I think
good analogies
first
you
one
got?
that comes to mind is consistency. And it's, if it's running is the sort of sport where it really builds on itself over time, where you can start running and you see some results after a year or 2 years, but like the thing really starts to pick up steam after 4, 5, 6, 7, 8 years, sometimes even a decade. And I think that really speaks to investing, where, it's staying the course. It's having a diversified portfolio that you are willing and that you like, and that kind of fits your goals and your risk parameters, but just staying with it and having faith that it will play out over the longer term. Dick Fredericks, one of our founding partners, likes to say, the kind of the eighth wonder of the world is compounding interest. There's the power of compounding, and you don't get that if you're constantly moving in and out and in and out on a wholesale basis. Goes back a couple minutes ago to having different types of managers in your portfolio, but on a wholesale thing, you do kind of on the whole want to benefit. And it's like, I have friends who ask me, where's the market going to be? What's it going to do? And my response is generally, I'd probably be higher in 2 to 3 years. And I think that kind of outlook is pretty consistently, it's optimistic, but it's also generally borne out to be correct over the history of things, given that the market is higher now than it was at any point prior, basically. And I think that sits with running, where it's just kind of staying the course and sticking with your convictions and having faith in kind of the day-to-day training or investing that you're doing, where once you kind of have the method that you like, sticking with it, and not kind of trying to jump around and switch things up on a dramatic basis based on things that roadblocks or kind of hurdles that come up in the way.
Yeah. I think about the quote. I'm trying to remember who said it. I'm always good at remembering quotes, and I'm always bad at remembering who said them, It's like, there's one though that is like, investing is not supposed to be exciting. It should be more akin to watching grass grow or watching paint dry. And, and I think there's something there at the end if you want excitement, head to Vegas or something like that,
Yeah, I mean, I agree with that. It's like for so much of the running career, and then the investing too is on a day-to-day basis. I don't want to say it's boring, but it becomes kind of routine. You know what you're doing. You kind of get used to it. I enjoyed the process on a daily basis. But at the same time, if somebody kind of looks in and doesn't know what they're looking at, they can say, man, like that looks like a lot of the same stuff. And you're like, yeah, it's kind of what we say is it's blocking and tackling, where it's just day in, day out, kind of looking over, doing the same things, kind of making sure you know what you own. And it's mundane, for lack of a better term. It's a lot of similar stuff. But the result is kind of staying the course and, kind of keeping in mind the longer time horizon. It's not about instant gratification. Like you said, if you want instant gratification, go put it all on black. The stock market.
You said that, not me.
The stock market for investors, what's the joke? It's like, all right, well, everybody who owned, First Republic is now an investor. And it's that time horizon, I think, that people kind of want this instant gratification. They want it to be exciting and, left and right things happening all the time. And, there's always a headline to be had, but it's really hard to act on all those headlines. And 9 times out of 10, it's already reporting something that's already been priced in. So I think just kind of sticking to your knitting and going with what and what you're comfortable with is really important over the long term, even if it kind of seems like, you're like, well, this isn't a whole lot of new stuff. What am I doing here? And it's just having faith that it'll work out over time.
Yeah. I'm not 100% a total efficient, market purist, right? I don't think the market's totally efficient, but I do think that price does tell the story really well as a tactical, or not tactical, but technical guy. I do believe that there's a lot to be learned just from that, but that the price is already discounting those headlines. And so by the time that you're reading the headlines, or by the time that you're seeing the things, your opportunity to make that decision with edge is likely already gone.
Yeah.
Right. So having a plan in place and a portfolio that can weather, different market environments, different economic environments, different political environments, and you can feel okay about the deviations from the mean on that in either direction is pretty critical. So
yeah, I fully agree with that.
It sounds like that's what you guys are trying to do with your fundamental analysis. So
yep,
get into the same place by a different path, and that's okay.
I think,
certainly
I
appreciate
mean, I
that.
think that's one of the nice things is everybody we work with, you've all got, you know, whether or not you kind of forget it, but you all have a similar goal. You
Yeah.
might disagree on how to get there, but your goal is to help your clients make money so that they can live the life that they want to live, whether it be, whatever their goals are aside. But it's you kind of sometimes have to be like, all right, well, I don't necessarily agree with that investment process or that tenant or whatever it might be. But you have to remember that ultimately, we're all in this business for a very, very similar, a common reason. And that reason is to help people do what they want with their money and to make money for them. And there's a lot of different ways to get there. But I think remembering that it's, nobody got into this game to say, I want to start out with less than or finish with less than I started.
Yeah. I mean, I got into say to finish with more than I started. That's for sure.
Yeah, exactly.
Yeah.
Exactly. I'm pretty sure if you really wanted to distill it down, most people would agree with that statement.
Yeah, I don't think really anyone invests to lose money. Some people might invest and want to see a stock price go down, but that's a whole different concept, right?
Yeah. But that's their end goal is still the same.
The end goal is still the same. Again, same end destination. MapQuest took them a different way to get there. But
yeah, exactly.
For the people listening that remember what MapQuest is, even.
Oh man. Yeah, printing out those directions before you had your phone to show you.
Yeah, I was like, back in the day when they'd say like, okay, and then when you get to the gas station, you'll see it on the left, and then you take the next right.
Yeah.
You're like, what?
The pizza delivery was a miracle.
Really, actually, like quite impressive that it all happened as smooth it was. And I think the thing that people forget about too sometimes is like even before pre-internet, just taking a second to remember like how crazy the world has advanced. When people think like, oh, AI can't make that big of a change, and then you just think about the difference that the internet being a common thing that homes and businesses had easy access to is like, imagine the Pizza Hut before they had internet, and they're like, you just give them your address and they're like, trying to look on a map somewhere.
Yeah.
And then draw. And then hopefully, they got the pizza delivery guy that's just like a local or has been there a long time. And he's like, oh yeah, I know where that road is, and hopefully knows an efficient way. And now, the internet gave rise to something that would just do a quick calculation for them. Right.
Yeah.
And now, what's the advent of AI going to be and the efficiency that brings? It'll be really interesting to see what happens over the next 10 years with all of that. But
yeah, for sure.
Not to delve, deviate too much and get down the
that's a different rabbit hole.
That's an absolute rabbit hole. But the whole thing made me think for a second. So, anyways,
no, it's wild. But I think people are really quick to forget how much we've benefited. When I started here, my Dick Fredericks I mentioned earlier, he had and still has a presentation called The Back Half of the Chessboard. And it started out basically with like, what was the best day to be alive? And he's like, today. Like, today is the best day to be alive. And guess what? Tomorrow is going to be better. And it starts with like, well, we started with rock tools. Now we have a hammer. Now we have indoor plumbing. Now we have electricity. Now we have the internet. And there's just these things that kind of get layered on top, and you just start to take for granted because it becomes such a quote mundane part of it. And yet you look, and when you can remember these seed changes, like for us, the internet being a thing, and remembering life before that is wild. My daughter, who's 7, I tell her, we didn't have iPads when Dad was a kid, and she's just like, her mind is blown. Like, she cannot fathom.
What did you do?
Yeah, like what did you do? Like on a car ride? Like, what am I gonna do? I'm like, you can stare out the window. Like, that's what I did. We didn't have any other options. Yeah, I think people are quick to, to anchor on recency and say, oh, like, the phone's 5G now. Well, LTE is just behind us. And, 3 years ago, LTE was the bee's knees. And it's, things are changing quickly. They're changing quickly for the better.
Yeah, it'll be really interesting to see how it shapes the landscape and what it does to the fundamentals. As a fundamental guy and, the metrics that you guys do, certainly some of the forward-looking earnings on a lot of this stuff is great, but the current can be so overvalued, right? There's a huge discrepancy between kind of current valuations and forward-looking valuations, right?
Oh, for sure. And we've had to, we have our thematic strategy, and we've had to kind of, that's very, very forward-looking. And you're like, well, all right, earnings aren't really applicable here. Like, these companies do, a lot of these companies don't have earnings. And so how do we kind of apply our process, shift our process to kind of keep it consistent and yet be able to look at these things in a way that we're comfortable and familiar with and feel like we know what we're doing. It's fascinating.
Yeah. I heard someone say once that recession is the investment equivalent of jumping out of a window, and the PE ratio just tells you what floor you're on.
Yeah. That's it. I like that. Yeah. I like that. That's a good one.
So,
yeah.
But I have found it interesting in the market recently, like just that huge discrepancy between the current earnings and then forward-looking earnings projections, especially in the current environment with AI and the integration and efficiencies of that. I think one of the interesting things that has happened is the thinning of the workforce, particularly in the tech space, where you would almost expect that to happen first, right? With AI, if things are becoming easier and coding's faster and easier, and you start shedding that labor force, well, that's a huge cost for those companies to save, which then would theoretically, increase the fundamentals, which lifts valuations. And we've seen that in the stock price, right?
Yeah.
Of so many of these companies. So
yeah,
anyways, all super interesting stuff. I think we're kind of running out of time here, Alex. But I definitely appreciate your guys' time. And appreciate, it's certainly an enjoyable experience to work with you guys over at Main Management. Meeting Davis was awesome. Davis is a great guy.
Yeah, he's fantastic.
You're certainly pretty sharp, and the whole team over there. If somebody wanted to, just find out more information about what you guys do, where's the best place to find you guys?
Our website's a great spot, mainmgt.com. Our funds, you can find them at mainmgtetfs.com. That's a plural, so mainmgtetfs.com. We're on LinkedIn, we're on Twitter or X or whatever you want to call it. We have, we try to put out pretty regular content from our research team here. And I think, those are the best places.
Cool. Awesome. Well, appreciate you coming on, and we'll, catch up soon.
Yeah. Thanks a ton for having me. Really appreciate the conversation and the partnership. Thank you.
Any hypothetical example contained in this document are for illustrative purposes only. They do not represent the past or future portfolio composition or performance of any specific investment and are not intended as investment advice. We suggest working with your financial professional to see which allocation opportunities may be right for you.